Waters Corporation may not be a household name, but its impact on science and industry is huge. Founded in 1958, Waters has grown from a small startup into a global powerhouse, shaping the way scientists approach complex analytical challenges. The company is a global leader in analytical laboratory instruments and software. Waters designs, manufactures, and services advanced systems used by scientists worldwide, helping them unlock new discoveries and solve critical problems. Their technology is essential for research, quality control, and manufacturing in pharmaceuticals, biotech, food safety, and environmental testing. Pharmaceutical and biotech companies rely on Waters to test new drugs for safety and effectiveness, while food and environmental labs depend on their systems to ensure public safety. Their instruments can precisely analyze chemical components, ensuring medicines are safe and pure. Waters products also help detect contaminants in food and water, supporting public health and regulatory compliance across the globe. Academic, government, and industrial labs use their tools for cutting-edge research and innovation. From developing new therapies to monitoring environmental pollutants, Waters technology is at the heart of scientific progress. In short, wherever precise chemical analysis is needed, Waters is there. The company's reputation is built on precision, reliability, and innovation. Waters is a key player in the scientific ecosystem, enabling breakthroughs and ensuring product safety for millions of people. Their performance is closely watched by investors as a barometer for the life sciences industry. That's why what happens at Waters matters far beyond the lab, influencing industries and lives around the world. On February 9, 2026, before the opening bell even rang, Waters Corporation's stock experienced a dramatic and unexpected drop. The suddenness of the decline sent a ripple of concern through the financial community, as investors and analysts scrambled to understand what was happening. In pre-market trading, shares fell by 3.42%, a significant loss for such a large, stable company, especially before regular trading even began. This kind of movement is rare for a blue-chip stock like Waters. Within just a few hours, millions in market value evaporated, grabbing the attention of investors everywhere and dominating financial news headlines. Moves like this are rarely random. They're almost always triggered by new information or a major announcement that changes how people see the company's future. The catalyst behind the drop? Waters had just released its latest earnings report, a document investors eagerly awaited for clues about the company's health. Investors and analysts pore over these reports, searching for any hints or signals about the company's future direction, growth prospects, and potential risks. The market's reaction was swift and decisive. Something in the report clearly spooked investors and led to a rapid sell-off. The culprit wasn't hidden deep in the numbers. It was right up front, in the company's own outlook for the months ahead. Waters' guidance for the coming months was weaker than expected, signaling potential challenges or slower growth on the horizon. In the stock market, what a company says about its future can move the price more than anything it's done in the past. For investors, the future is everything. The main reason for Waters' stock drop was its first quarter 2026 guidance. Guidance is a company's forecast for future performance, crucial for investors. When guidance falls short of Wall Street's expectations, stocks often tumble. In this case, analysts had set their own predictions, but Waters' official numbers came in lower. This gap between expectation and reality triggered a sell-off. Investors had priced the stock for better results. When the company signaled otherwise, the price had to adjust. The market is always looking forward. Future outlook trumps past performance. Even a strong previous quarter can't offset a warning about the months ahead. For Waters, the disappointing Q1 guidance overshadowed any recent successes. It became the single most important data point for investors. The market's focus shifted instantly to the challenges ahead. Let's look at the numbers that rattled investors. Waters projected adjusted earnings per share for Q1 2026 between 2.25 and 2.35. Wall Street was expecting 2.51s, a clear miss, even at the high end. In corporate earnings, a gap like this is significant. It signaled weaker profitability than anticipated. Revenue projections also seemed soft, adding to the concern. Even though full-year guidance was steady, the immediate weakness in Q1 was enough to spook the market. Investors often react more to short-term warnings than long-term promises. The numbers told a story of a tougher road ahead. That's what drove the stock down. Ironically, the negative reaction came right after a strong finish to 2025. Despite the market's swift shift in sentiment, the company's performance in the final quarter was nothing short of impressive. Waters beat expectations in the fourth quarter, with adjusted EPS of $4.53 versus the $4.51 consensus. This outperformance, though seemingly small, demonstrated the company's ability to execute even in a challenging environment. Even a small beat is a big deal on Wall Street. It signals operational strength and can boost investor confidence, at least in the short term. Revenue for Q4 was $932 million, topping analyst estimates and growing 7% year-over-year. This kind of growth is especially notable given the broader economic uncertainty at the time. Sales were up across the board, showing solid demand for Waters products. The company's diverse portfolio helped drive this momentum, reaching new customers and markets. The company's management delivered on its promises and then some, executing their strategy with discipline and focus. These results should have been a cause for celebration. Employees and stakeholders alike had reason to feel proud of what they'd accomplished. But the market has a short memory. Future warnings quickly overshadow past wins. Investors are always looking ahead, often ignoring recent successes. The CEO praised the team's industry-leading results for 2025, highlighting their resilience and commitment to excellence. Still, investors focused on the cautious outlook for Q1 2026, weighing the risks of a potential slowdown more heavily than recent achievements. The strong finish to 2025 couldn't offset the weak guidance for the start of 2026. The market's reaction was swift and unforgiving. That's the reality of the stock market. Success is fleeting, and the focus is always on what comes next. Waters' late 2025 growth was broad-based and impressive. Both pharmaceutical and industrial sectors saw sales jump 8%. Pharma is Waters' biggest market, so this was especially encouraging. Industrial growth showed the company's reach beyond healthcare. Chemistry products, especially new bioseparations tools, led the way with 12% revenue growth. These innovations are used to analyze complex biological molecules, key for modern medicine. Europe was the standout region, with sales up 13%. Asia and the Americas also posted solid 4% growth. This global, diversified growth shows Waters' resilience and wide appeal. The company isn't dependent on any single market or region. Recurring revenue is a cornerstone of Waters' stability. This comes from services and consumable products customers need regularly. In Q4 2025, recurring revenue grew 10%, a sign of loyal, active customers. This steady income cushions the company against swings in big equipment sales. Service contracts and consumables keep revenue flowing even in tough times. A strong recurring base makes Waters' financials more predictable and attractive to investors. It's not just about selling new machines, it's about building lasting customer relationships. This foundation supports future growth, even when the market is jittery. Despite short-term worries, Waters' leadership is focused on long-term growth. A major move, the planned acquisition of BD Biosciences and Diagnostic Solutions. This deal will add about $3 billion in revenue in 2026, transforming the company's scale. It's a bold step, expanding Waters' reach and capabilities. The company's full-year 2026 guidance remains strong, with projected organic revenue growth of 5.5% to 7%. Full-year adjusted EPS is expected to be $14.30 to $14.50, matching analyst expectations. The CEO emphasized confidence in the company's momentum and strategy. Leadership sees Q1 weakness as temporary, not a long-term problem. The combination of a strong forecast and a transformative acquisition points to a bright future. Waters is positioning itself as an even bigger force in life sciences. Waters' stock drop is a classic case of the market prioritizing future expectations over past results. Investors saw two stories: a strong Q4 2025 and a cautious Q1 2026 outlook. The disappointing guidance for the next quarter outweighed recent successes. In the fast-paced market, the view ahead matters most. The 3.42% drop was the market's way of adjusting to new, lower expectations. Even solid full-year forecasts and big acquisitions couldn't offset the immediate bad news. The fundamentals, recurring revenue, market leadership, remained strong. But the Q1 guidance became the focal point. It's a reminder. In the stock market, perception and expectation drive prices. Even great companies can see their stock fall if the near-term outlook dims. For Waters, the next few months, not the last few, are what matter most to investors right now.